Alright, so now we start with materiality. And I'm going to take us back to the basics just so that we can really grasp this concept. So, what is materiality? All I've done is I've put the sentence that for me best describes materiality. And I say that materiality is the benchmark for significance to the users of the financial statements as determined by the auditors of a company. So what I'm saying here is the auditors need to define what they feel will be significant to the users of the financial statements, and once they've defined that, they need to set that as their benchmark. Okay, so what do they believe will be significant to the users of the financial statements? And guys, that's a very hard question, because how many users are there of the financials? There's so many. In fact, there will be users that the auditors don't even know about. There's employees, there's investors, there's creditors, there's debtors. There's so many parties that are interested in these financials, and for different reasons. So the auditor has to go and decide what do they think will be significant to any user of the financial, and that is how they are going to determine materiality. But why is materiality then even relevant? Why do we as auditors need to determine what would be significant to the users? What is the purpose of materiality? Guys, if we go back to the objective, the beginning of the lecture, the objective was to find out if the financials are free from material misstatements. Material meaning important to the users. What is important to the users? Misstatements, but a specific type of misstatement. Not all misstatements, only the material misstatements. So our objective to express an opinion on whether the financials are free from material misstatements is why we have to determine materiality, because materiality is what is material. It's our benchmark. So I've said here, misstatements, including omissions, are considered material if they individually or in aggregate could reasonably be expected to influence the economic decisions of users taken on the basis of the financial statements. So look at that sentence again. It would be material if it affects the decisions of the users. So now let's break up our understanding of a misstatement. A misstatement is the difference between the amount, classification, presentation, or disclosure of a reported financial statement item and the amount, classification, presentation, or disclosure that is required for the item to be recorded in accordance with the applicable financial reporting framework. So it's the difference between how an item has been recorded compared to what it should be recorded. But look at all those differences, guys. Amount, classification, presentation, and disclosure. So when we're looking at a misstatement, we're not just saying that we need to find what would be material in number or amount. We've got to also determine what's going to be material in terms of incorrect classification, incorrect presentation, incorrect disclosure. So the misstatement shows us that there is a lot we need to consider when we are determining our benchmarks for significance to the users. because we are looking to make sure or to express an opinion on whether the financials are free from material misstatements. But there's so many ways in which something could be misstatement, so how do we set the benchmarks for those? Okay, and because of all of these differences, guys, we have to have different materialities, different benchmarks for what would be significant to the users. And that's why we come up with a quantitative materiality and a qualitative materiality. So our benchmark, quantitative, is going to be an amount, a maximum figure that is acceptable in terms of misstatement. So that deals with the first way in which something could be misstated. But there were other ways in which something could be misstated, incorrectly classified, presented, or disclosed, and those aren't an amount. So we have to now also have qualitative materiality. And guys, because there's so many different financial statement items and different presentations, classifications, and disclosures, qualitative materiality cannot have one set benchmark. So ultimately, qualitative materiality is your IFRS requirements or your financial reporting framework requirements, because we know it's IFRS. So what are we saying? If a financial statement item is presented or disclosed or classified in a way different to what the IFRS requirements show, it would be qualitatively materially misstated. However, when we're looking at amount, if the financial statement item is recorded at an amount different to what required by the financial reporting framework, and that amount is not in excess of the quantitative material figure, we will ignore that as a material misstatement. Okay, so when it comes to looking at the amount, quantitative materiality is going to determine if it's material or not. But when it comes to the classification, presentation, disclosure, if it's not done in accordance with the IFRS requirements, it would be qualitatively materially misstated. So guys, qualitative, it's dealing with the actual nature of this transaction and the difference between how it's been recorded and how it should be recorded based on the nature of it and how it should be classified, presented, or disclosed. So qualitative, guys, it's going to be as simple as this is what IFRS says, this is what they've done, okay, here's the difference, there's a qualitative material misstatement. Quantitative, it's all about the amount, but we've said here there's a max amount that is acceptable. Quickly look back at the previous slide. It is said that a misstatement is material if they individually or in aggregate could reasonably expected to influence the economic decisions of the users. So now we're saying that you're not only going to look at the misstatement by itself, there could be multiple that needed to be added up to compare to materiality to determine if it's going to affect the user's decisions. So because of that aggregate, guys, we cannot use the maximum amount that is acceptable for the financials to be misstated to look for risks of misstatements. Because we are then going to ignore misstatements or risks of misstatements that are below that amount, which, if aggregated, could exceed that amount. So when it comes to quantitative materiality, we have to be conservative in the figure that is used. And in order to do that, two figures are going to be determined. For quantitative, there is going to be planning materiality and performance materiality. Two material amounts. And they differ. I'm going to show you the difference quickly here. Planning is going to be more and performance is going to be less. There's just one way in which they differ. And here is the reason, guys. Planning an audit solely to detect individual misstatements in excess of the maximum amount acceptable overlooks the fact that the aggregate of individual misstatements below this maximum may cause the financial statements to be materially misstated. Look at that again. If we plan it solely to identify misstatements above the maximum, we are going to ignore misstatements that are below the maximum amount. But when added up, they exceed the maximum amount, and then ultimately the financial statements are not free from material misstatements as a whole, because when I add them up, they exceed that material figure. So because of this, we work out two materiality figures. One, planning, which is the maximum amount. So this, in excess of the maximum, this is your planning materiality. And the second one, performance, is going to be a new materiality that is lower than the maximum, and this is going to help us to identify those misstatements that are below the maximum, that I then would need to at the end add up to see if they in aggregate exceed the maximum. So this is performance. It's going to be used in the audit to identify misstatements below the maximum amount. And guys, why is that? Because we as auditors cannot test everything. We cannot go and find every single misstatement in this set of financials, because then we would be doing the accounting on the daily basis for this business. It's impossible. We test samples. We give opinions. So all of that requires or is expected that we are not doing everything. And as a result, our opinion is whether there are material misstatements, not other smaller misstatements. So because of that, guys, we need to set our benchmark. Here's our benchmark for looking for misstatements in the performance of the audit that are above this performance amount. Because I'm not going to look at items that are smaller than that, because I don't have the time, the capacity to do that. So we're going to have an amount that's smaller that we use in the audit to pick up misstatements, so that those can be aggregated to compared to the maximum misstatements amount, which is our planning materiality. If we use planning materiality, we are going to ignore multiple misstatements that are below it, but when we add them up, they could exceed that. So all we do is we work with less to pick up more misstatements, so that we can then compare those in total to the maximum misstatements allowed. So, I've said it here. Planning is the total quantitative material misstatements acceptable in the financials. The total rand amount of misstatements acceptable in the financials. And guys, to make it even easier for you to see, I'm showing you the 2 stages that we use planning. Planning is calculated in the planning stage to set the benchmark for the maximum misstatements, and then it's used in the concluding stage to assess the misstatements identified. So, planning is used in 2 stages. Planning materiality is used in the planning stage and in the concluding stage, not in the performing stage. Remember the audit process? We've got pre-engagement, planning, performing, concluding. It is used in the planning and the concluding, not in the performing. So we set our benchmark for the maximum in the planning so that we've got an idea of where we're going. And then in the concluding stage, we use that to look at the misstatements that were picked up in the audit. Performance materiality is the smaller quantitative amount the auditor uses during the audit to identify areas where there could be misstatements in excess of performance materiality. So guys, when we are performing the audit, the materiality that we are using is performance. So performance materiality is the materiality that we're using in the performing stage. And this is what we use to identify misstatements in excess of this amount in doing our audit work. Why? Because we want to find as many misstatements that are reasonable to us. So the performance benchmark, we believe any misstatements below that are fine. We can ignore them in the audit. But misstatements above that we want to know about, because these are misstatements that we want to go and check at the end when they aggregate that they don't exceed the planning. So where are we going to use performance? We need to use it to identify areas where there could be misstatements in excess of this amount. So we are going to use it to identify risks of material misstatements in the financials. And which material are we looking at? Performance materiality. We need to use the performance materiality to help us to identify the risks of material misstatement in the financials, because our goal is to express an opinion whether the financial statements are free from material misstatement. Now, in our opinion, we are talking about free from material misstatement being the planning materiality, because that's the maximum. But in our performing, we are going to be identifying risks of where there could be misstatements in excess of performance, because we want to pick up more areas of where there could be misstatements and more misstatements than just the maximum amount. So I use performance to identify the risks of material misstatements. And guys, ultimately that means that we are going to use this figure, performance materiality, to help us to select the account balances and the class of transactions that we want to test, because we would pick up there could be a material misstatement based on the amount of that balance or transaction and performance materiality. We are also going to use it to help us then to select our samples for testing when we get into the performance stage. So in the planning stage, we calculate 2 materialities. One is the maximum, and that one we now leave once we've done our calculation. We then calculate performance, and that is the materiality that we are going to be using going forward. That is the materiality that we are going to use to help us to identify risks of material misstatement, and it's performance material that we're looking at in terms of the risks of misstatements there. And when we get to our testing, the balances and transactions we want to test, the sample size that we need to test is all going to be with our performance materiality in mind. Okay, so how do we go about calculating either of these materialities?